Good day, everybody, and welcome to lesson number 3 in the Ben and Boz Narrated PowerPoint series. I'm Boz.
I'm Ben.
How are you doing today, man?
It's a beautiful day in St. Joe Township.
St. Joseph Township, Minnesota. That's right. That's where we are. Switching it back with Sartell with the last one. Now we're back to St. Joseph Township. Who knows where we'll be next time?
You know, I'm excited to learn about the income statement, Boz.
Are you?
Yeah,
All right.
I am.
Well, I tell you, I'm going to take the helm today, then I'm going to teach you a little bit about the income statement. How does that sound?
I like it.
All right.
I'm in.
You're in. Well,
Let's do it.
Well, good.
I'm
you said
excited
you
to
weren't
learn.
in. I don't know what would happen, but all right. Well, the income statement. So let's start off with an example here.
Good idea.
So we have an income statement here, and I prepped this one, and you weren't even fully sure it was who it was at first, right?
No, I wasn't. What threw me off is that I saw there was net product sales and net service sales. So it's a company that has both a product and a service, but they also have significant technology and content expense. And so I wasn't quite sure who it was, and well, I'm cheating right now because I can see the answer, but
and it is Amazon's income statement. So we look at that one at the income statement. As Ben said, net product sales, net service sales, total net sales here, and we'll ask some questions that trigger discussion. Oh, go ahead.
I was going to say, what do you think those service sales are?
What do I think?
Because when I think of Amazon, I think of, well, I'm going to go online, I'm going to buy my product, and it's going to show up magically a day later.
Yep.
So what's the service?
Well, I got to assume Amazon Prime memberships are in there. And
Probably.
That's going to be a pretty substantial one. So I don't know if they probably do some warranty services on some of the products that Amazon. I mean, they asked me if I want to buy warranties periodically. Okay. Did you have any other guesses on that side?
I was anticipating they might have some cloud.
Oh, cloud! Yeah, totally.
They provide some service around that.
Yep.
Maybe.
I think they sell. Well,
probably sell data, I imagine.
Some data, and I was just kind of wondering about their movies. You know, some of that you get through Prime.
Yeah,
I don't know if that would I don't know if that'd be a product sale or if that would be a service sale, like when they're actually, if you want to buy a movie or something like that or rent it.
And the same thing applies to Amazon Music, where you can
totally.
not just through the Prime, but get the higher membership with the music. Is that a service or is that a product?
Yeah, we'd have to dig. We could dig in and learn more. So, but yeah, those are a couple of their big accounts there. $177 billion in total. So the first question there is Amazon a profitable company? So I created these slides, and when you saw that question the first time, where did you look?
Well, actually, I looked a couple of places. Profit, obviously, you think you're going to be drawn to net income down at the bottom.
Yep.
And you see that, all right, they started at $596 in 2015. Then in 2016, they bumped way up to $23.71.
Yep.
And then they're at just a hair over $3 billion in 2017.
The simple answer, yes, they're profitable.
Yes, they are profitable.
Yep.
But then I dug a little bit more and going up the income statement. So that net income's the bottom line.
Yep.
And we're going up the income statement looking at, well, operating income. Have they had steady operating income growth as net income has grown?
Yep.
And it looks like 2015 to 2016 from 2.2 billion to 4.2 billion. Yeah, they grew a ton.
Almost double.
Yeah, but then 2017 it kind of stagnated.
Yep. It's an interesting point there. I mean, their revenues really grew, but their expenses grew even a little bit more then, and that's why the operating income went down. And then really the only reason that net income was up, if we keep tracing this one down, because, well, we could actually look income before income taxes is down as well, but then net income is up. The reason is the provision for income taxes, and that actually relates to the tax reform that we just saw, some of the corporate tax reform. The actual reasoning behind that is way beyond the scope of this presentation today. So
that is interesting because provision for income tax is for 2017, but I thought tax reform only kicked in 2018.
If you really want to know on this, because I'm a tax guy, this relates to the remeasurement of deferred tax assets and liabilities at the lower corporate tax rate.
Sounds like a great topic for intermediate accounting.
For like way beyond now, yeah, that's right. But yeah, so are they profitable? Yes, we looked at some different lines of profitability. How much have they grown over the past 2 years? It depends on what you're talking about with growth, but you could go right up to the sales line. They've gone from $107 billion to $177 billion in a 2-year period. So that's $70 billion of growth. That's about 65% growth over a 2-year period. That's huge.
Pretty good, but look at net income growth.
net income growth has gone up by about 5 times over that period. Now, some of that is that tax reform in there, but if we look at the income before income taxes, or maybe that operating income, it's roughly doubled over a 2-year time frame.
It is interesting. Over 2 years, you see a lot of the growth, but just from 2016 to 2017, maybe not as much.
That's true. A lot of sales growth.
At least in the operating income.
Yeah, exactly. And then is Amazon paying more taxes as it grows? Well, certainly from 2015 to 16, as they grew, they paid a lot more taxes. But then their taxes went down in 2017
we
due to tax
jumped
reform.
The gun on
We were excited about it, but we're the hosts. We could do what we want. But
I like that.
Yeah, totally. So an overview, what we're going to be talking about today, we're going to understand the concepts of cash versus accrual accounting. We're going to understand
it's accrual world, boss.
That's like a really lame old joke. It's accrual world.
Accrual world.
You were waiting like so long to say that. But, all right, understanding.
No regrets.
No, that's great. Understanding revenues, expenses, and net income. Learning how to prepare journal entries for the income statement accounts predominantly. Learn how to prepare an income statement. That's the fourth one. One concept that we want to talk about first is the operating cycle. Just so you understand how companies operate. So a normal company, they don't start with sales because you need something to sell. All right, so companies purchase goods. That's the first thing that they do so that they have something to sell or something to manufacture with. And they often do that on account, meaning they don't pay for it right away, but they're going to promise to pay later, oftentimes maybe 30 days later. And then the companies are going to pay for those goods with cash. After that, then they are going to sell the goods, again, often on account. They might give their customers 30 days or so to pay, and then the customers will pay them, and the company will receive payment, and they'll just kind of continue that cycle. And certainly, real-world application, a lot of this is happening at different times, and it's intermingled and everything.
It seems kind of risky to me. If you're buying something on account, so you promise to pay, but what if all of a sudden sales fall through and you don't get the cash to pay it? Yep. Couldn't that be a little bit of a risky cycle?
Totally happens, and in that situation, a company will usually borrow at that point in time. So they'll go to the bank, try to borrow some cash. If that doesn't work, they could go to the stockholders and ask for some more capital. If they can't access those two things, you could have a company that ends up declaring bankruptcy at that point in time, basically because they purchased too many goods that they couldn't end up selling.
So, interesting. Wish we knew how to calculate some of those times.
That's true. Calculate those times. I think that's lesson 12.
It is lesson 12.
We're only on lesson 3.
Trying to tee you up for that. I'm excited for it.
You think anyone will keep listening all that time?
Well, I think you're going to mandate it in your classes.
That's a good point. All right. Accounts receivable and payable can be significant. And again, we just kind of talked about those on the operating cycle. So for Walmart, we think of Walmart's revenue, they're finally above $500 billion, so a half trillion. Well, they grew really rapidly for a while, and then they slowed down once they approached that $500 billion mark. Costco's really, and Amazon have been big competitors of Walmart. Their accounts receivable are not too big. Well, when I say not too big, I mean that's $6 billion. That would be big for me. But for Walmart, that's not super huge because they're mainly selling cash.
Yeah, I was going to say that'd be interesting because credit cards here don't count as accounts receivable. And so, because usually they collect those within the next day or even the same day. And so that accounts receivable, do you know what makes that up?
I don't know if they offer some financing to some customers for larger purchases.
Maybe some like commercial customers.
Possibly some of that kind of stuff that would fall in that. But they do have huge accounts payable for $46 billion. That's what they owe their vendors. That's what they owe, Johnson & Johnson or Kraft Foods or just all the vendors that are out there.
That's probably part of their cash management strategy, though, right?
Yep,
Try and delay the payable as long as you can and shorten the receivables so you collect as quickly as you can.
Totally. And then just pulled an example of another company that also has big receivables, though. So Walmart's there's the Fortune 500 list, the 500 companies in America with the most revenues. Walmart's number 1. Number 2 is ExxonMobil with $244 billion of revenues. And I wanted to show the difference there. They have accounts receivable of $21 billion and accounts payable of $22 billion, very similar. So just an example of ExxonMobil accounts receivable are a lot more significant compared to their revenues than for Walmart. And that's just selling, I believe that would just be selling gas to the gas station.
Yeah, I would imagine it's probably the nature of their business. Walmart is direct to customers, whereas Exxon sells it a lot of times to another.
Goes to the business
first.
before the end customer. Exactly. So if we look at revenues and throw a few definitions, and again, we just got Amazon on the bottom for you, but it's a mouthful, but revenues are inflows of assets due to regular or ongoing transactions. They can be in cash, like we saw with Walmart, or they could be in accounts receivable, which ExxonMobil does a chunk of, and then when that gets collected, it becomes cash.
Yeah, so a simpler way of saying inflows of assets due to regular ongoing transactions, it's when your company provides a service or a good, and they're going to get paid for it, either immediately when they provide it or sometime down the road.
Yep, exactly. And so in the revenues, we record them when they're earned, and they're considered earned when the goods are delivered or the services are provided. And just go ahead.
Oh, I was going to say that's already a simplified definition. They just came out with some new guidance on revenue recognition that it's really a lot more complicated than that, isn't it?
Yep, absolutely. So probably an intermediate accounting course, you dive into more of those definitions behind it.
But in this course, we'll stay higher level. It'll be very clear when it's time to recognize revenue.
Yeah. So these are the accrual accounting rules, and it's important. This isn't when cash is received. This is when you're delivering goods or providing services. And one thing to point out is just there is something called a gain, and that's more of a one-time isolated event. You can see it's an inflow of assets due to a peripheral transaction. That's a gain. So that would be if Walmart actually sold one of their stores or a piece of land.
I was going to say one of their trucks.
One of their trucks, yep.
And they don't always have a gain. It could be a loss, which we'll get to. But
you're like teeing up the next slide.
We'll say that truck was worth, on their books, $100,000, and they sold it for $150,000. They recognize a gain of $50,000, but that wouldn't fall into revenues because revenues is for regular, ongoing, and they're not in the business of selling trucks.
They are not. Yep.
Maybe they should.
I wouldn't buy one.
Drive revenue growth.
Well, perhaps, but sell your trucks that you don't have anything to deliver your goods with. But different discussion. So expenses, just kind of the opposite. It's the outflow of assets due to the regular ongoing transactions. Again, it's usually in cash or through a payable or liability, which you then will pay for in cash. It's recorded when it's incurred. So with expenses, a key term is incurred. And they're trying to, the accounting rules, GAAP rules are trying to match the expense to the revenue. So in the period you earn revenue, you want to match the expenses to it in that period. There's specific requirements in order to record an expense. It has to be probable and reasonably estimable. So, yep.
So basically what that means is, yes, you're going to have to pay it, and estimable, you can guess how much it's going to be.
Yep.
And so I like to think of, when I think of the word expense, I think of cost of doing business for a lot of these, where Walmart, they have to keep the lights on, so they're going to have an electricity expense every month or every year, whatever they're recording their financials.
Yep, exactly. So, and when we say estimable, that's because you don't record the expenses just when cash is paid. You record them when they're probable and reasonably estimable.
And that actually fits in with the electricity bill. So say Walmart, it's December, they receive an electricity bill, they have to record an electric expense or utilities expense in December because that's when they use the lights, even though they're not going to pay that bill until January.
Until next year.
So cash isn't going out the door until January. They still have to record the expense in December.
Because it was during December when the lights were on trying to, help them sell the goods basically during that period. Yep. And then an outflow of assets due to a peripheral transaction, that's a loss. Just go to Ben's example. Walmart has a truck for $100,000. You only sell it for $60,000. You got a $40,000 loss. It's an isolated event. A knowledge check, going to let you do this, Ben. All right. So order the accounts as they would appear on the income statement. Right now they're in alphabetical order.
Okay.
All right. So
we're going to start with revenue because it's always going to be revenue minus expenses.
Yep.
And we have sales or service, but I remember Amazon had sales revenue first, And so I'm going to do sales followed by service.
And I don't know if you actually have to include those in that order. I mean, the point is revenues are first. So
I don't know this, but I'd be willing to guess they probably put whatever is highest.
That's a good
first,
point.
Maybe more significant to the business.
I was going to say I'd take that bet. No, I'd bet with you is what I mean. So
we got to find someone who
will
wants to
bet
bet
against
the
us.
opposite
If you're
side.
listening and you want to bet against us. So. All right. So which of the expenses is going to come first?
Cost of goods sold, or cost of sales in this case, usually goes next, right after revenue.
Yep. Then what kind of expenses?
Then I'm going to go with general and admin expenses.
Sure. So, and what are general and admin expenses when you think about those?
When I think of that, I think that'd be like your selling expense, your marketing expense, maybe your insurance expense, maybe rent on an office building, things like that.
Yeah. Salespeople, your headquarters employees, CEO, people like that, and other things you listed. How about after that then?
Then it gets a little bit trickier, but I'm going to go with interest expense.
Interest expense, yep.
And then we're going to put the gains and losses. Sometimes those are netted together, aren't they?
I think it probably depends on how big they are. I believe I've seen that one both ways. So which order those go into, I don't think is critical on this one, just to know that they are together. Mm-hmm. All right.
And then the last one, always the last expense you're going to see is income tax expense.
Good job, Ben. 8 for 8. You get an A for today.
Thanks, boss.
Proud. So.
In fuego.
In fuego. That's right.
I don't know how to say on fire in German, so.
You might have to look that up. But. So subtotals on the income statement. You know, the first one that we have is gross margin. Amazon actually did not have that, but I think most companies do have that. It's sales minus your cost of sales. You have something called EBITDA, earnings before interest, taxes, depreciation, and amortization. So you're going to also subtract from that one your selling, general, and administrative expenses. And this is an important metric that's actually looked at by investors, and that's why we are going to pull that one out separately. We've got operating income, which is then going to subtract depreciation and amortization.
So investors just drop the DA.
Drop the DA. That's right.
Good.
That one's also looked at quite a bit. We have income before income taxes. So we're going to subtract the interest expense, net of the interest income, and then subtract the peripheral losses, net of the peripheral gains. Mm-hmm. And then finally, we're going to get down to net income. In order to get there, we are going to subtract the income taxes.
There's a lot of steps. I think it's good to point out that not every company is going to show each of these different breakouts.
Yep.
And not that they don't know the breakouts, but for different purposes, they're going to show different income statements.
Yeah, and Amazon didn't even show them all. So it's just what they thought would be the most useful to their investors.
Got a side question for you.
I'm ready.
I've heard the income statement also called the profit and loss, or the P&L. Mm-hmm. Do you know why it's called income statement or P&L, or what the difference is?
I do not know the history on that. I would have gone back to just the difference between hola, que pasa, and all the different greetings. You know, it's just different ways of saying the same thing. Had you had any different opinion on that one?
No, it was just a good question. On my experience, I figured income statement was used more academically, and P&L, or profit and loss, was used more when I was working.
Okay.
And so if you're listening, I just don't want you to be surprised when you start working and someone's asking about the P&L or the profit and loss statement. Just so you know, it's the same thing as an income statement.
It means the same darn thing. So it's just kind of like my wife and my spouse to me are the same thing. Mm-hmm. So why should you care?
Same person.
It's the same person. Yeah, that's the same thing. Same person. So
I knew what you meant.
I appreciate it. So why should you care about the income statement? Well, investors and creditors, they want cash from their returns, and you're going to generate cash from the income statement, because net income and cash flows over the long run are usually somewhat similar. Not exact, because there's different rules about when you record income and expenses, but they're going to be somewhat similar. Increasing revenues often gives you increased income and increased cash flows. Not always, but often. Expenses, you want to look at them. You know, are they increasing more or less quickly than revenues? We saw some of those with Amazon, that maybe the expenses weren't always acting the way we would have expected. And then net income. You know, we got to analyze the income statement to understand if that's increasing. It's one of the top metrics looked at by investors.
And just a quick note on cash flows. Just because a company has positive cash flows or positive net income, that doesn't mean that all the investors get that cash flow or get that net income. a lot of times companies will reinvest most of that back into the business.
Yep.
But after a company matures, then a higher percentage of that cash flow or net income is going to be dispersed through, say, dividends.
Yeah, exactly. It's a great point. So the accounting equation.
Oh, I love this thing. I'm glad to be back at the accounting equation.
You love I'm glad you love it. You're an accounting dude, but so
dork, I think. Is
accounting dork.
Yeah,
yes.
that's fine.
Yes. So assets equal liabilities and equity. And again, as a refresher, this is straight from lesson 2. A debit will increase an asset, whereas a credit will increase a liability, and a credit will also increase equity. Now we're going to expand on equity a little bit. And we're going to see that a debit to equity generally will happen if you either have a dividend or a loss, whereas a credit will happen when you have income. So to break that out a little bit, revenues have credit balances and expenses have debit balances. So if you have revenues that are bigger than expenses, you're going to have a net credit, and that's going to be income. If you have expenses that are bigger than revenues, that would be a net debit, which would be a loss. So revenue examples. I'm going to quiz you on some of these here, Ben. You ready?
I think I can handle
I
it.
think you can handle it.
Ben
All right.
Trinka, CPA.
Yeah, we'll find out. So let's say a company provides $100 of services for cash. What do you got for a debit and a credit?
All right. Well, I know where we're going to be receiving some cash. So if we receive cash, it's going to be an increase in cash, which is an asset. So I'm going to debit cash for 100, and you just told me revenue is increasing on the credit side. So I'm going to credit revenue or service revenue for 100 as well.
Nice work. Nice work.
In fuego.
We're going to get a little tougher here, though. This time, the company is going to provide 150 of services on account.
Okay. Well, they're providing the services, and so just like I saw in the first one, we provided services. I'm going to credit revenue, service revenue, for 150, but the debit, because you led me on, I know it's not going to be cash.
That's right.
It's on account, so I'm going to put accounts receivable for my debit of 150.
Nice work.
Yeah.
2 for 2. And then after we sell an account, the next thing we're going to do is collect. So
Hopefully.
Hopefully we're going to collect. So we're going to say we do collect here. They'll have to tune back in on lesson, I don't know, maybe it's lesson 5 when we learn that we might not always collect on account. Yeah. But all right, we collect the $150.
All right, so we collected the cash, meaning we're getting cash. Cash is increasing. So debit my cash for 150, and then accounts receivable is the one I'm actually going to credit here. So I was owed 150. But now when that person paid me, they no longer owe me, so I should get rid of the related receivable.
Yep. Accounts receivable is an asset. An asset is decreasing. When an asset decreases, we credit it. All right, let's get on to another revenue example. Let's say that this time a company collects $200 of cash for services to be provided in the future. Now, this is a big, if this was the cash method of accounting, we would record revenue right now. All right, but we're under the accrual method of accounting, which is GAAP. So these services aren't going to be provided into the future. So I'm going to say the debit's definitely to cash. I mean, I know that. That's not the tough part. What's the credit to, though?
The credit is to unearned revenues.
And what kind of account is unearned revenue?
That's actually going to be a liability account because at this point, this happens a lot with insurance, right? 200 cash for services. So my wife and I, we just paid our insurance premium for our car for the entire year. We had to pay up front, and then we have car insurance for all of next year. And so what the insurance company is recording a debit to cash for $200 because they received it, but now they owe us insurance coverage for that next year. So because they owe us something, that's a liability when someone owes. Okay. So in that case, unearned revenue is going to be a liability account.
Yep. You owe someone. You owe someone that service. Okay, well, how about then in the future, let's say you perform those services then?
After I've been insured for a year, for example, well, in that case, the insurance company doesn't owe any more insurance, so they don't have any more of a liability. I want to get rid of the liability that I had, so I'm going to debit unearned revenues for $200 because debit decreases a liability.
Yep.
And then I provided the service, so now I can recognize revenue, and I'm going to credit revenue.
Yep. So unearned revenues is a liability. If you decrease a liability, that's through a debit. So that's why we have that. All right, now up to expense. So
Can I quiz you on these?
These are my slides. I know the answers. I know they're coming. So
okay.
But,
okay.
Well, you probably know them too. So.
I do know them, but that's okay. No, we're good. We're good. Go ahead. Keep quizzing me.
Well, you're doing so well. So,
all right.
A company pays interest of $100 in cash.
All right. Well, they're paying cash, so I'm going to credit cash. Cash is an asset, so decrease an asset means credit it. Credit cash for 100. And then this is where I go back and remember that accountants are not creative with their naming conventions.
Sure.
So if I see interest and I know these are expense examples, I'm just going to call it interest expense.
Wow.
So debit interest expense for 100.
That's right. All right.
All right.
How about the next one? A company pays income taxes of $90 in cash. And once again, the accountants are not creative with names.
Paid in cash, so credit cash for 90, and then they paid income taxes. I'm going to go ahead and call it income tax expense. Debit it for 90.
Exactly. Remember, when we have expenses, increases to expenses are debits. All right, we're going to get a little bit more tricky now. A company incurs wages to pay its employees of $250, but does not pay them yet. So this really means that someone worked, but and it comes to the end of the year and someone has done some work for us, but maybe we pay them every other week, and that every other week isn't going to happen until January 5th or something like that, right? So they work $250 worth of work for us in December, not going to pay them until January 5th. Then
happens
what?
all the time. Then, well, we already know we're not creative, so we have wages, and they've been incurred. We record expenses when they're incurred, and so we're going to debit wages expense for $250. But we haven't paid them yet, which means we owe them. And if we owe someone, that's my key, that's the liability. So I'm going to create a liability for wages payable because I'm not creative. So debit wages expense for $250, credit wages payable for $250. Final answer, lock it in.
And that's what it was. So I'd showed the answer by the time you said final answer, so that was less impressive.
Okay.
And now you know the fourth one. I bet you know what's coming, that we're going to pay off those wages payable.
All right. Well, if we pay them off, that means the cash is going out the door. So we're decreasing an asset, credit cash for $250, and then we're going to debit wages payable because we don't owe it anymore after we've paid it. So debit wages payable.
The liability decreases, we debit it. Now we're going to do a kind of a combined example.
This one's tough.
Well, yeah, maybe. I don't know. So it's tough if you're new. So combined example. And in this one, let's say a company purchases inventory for $300 on account. This is more of a lesson 2 thing right here. So,
yep. So this one, lesson 2, I created lesson 2, everyone.
You did.
So
you did.
Inventory is an asset. I'm going to debit that asset for $300. And it's on account, meaning I owe someone. So I'm going to credit accounts payable for $300.
Nice work.
There we go. It's on my books now.
That's right. Now we're going to have our first. I don't know. We have a transaction coming up that has 2 journal entries with it. So let's say
impacting 2 financial statements.
And this one is tough, definitely. So a company sells that $300 of inventory for $500 of cash. So the $200 difference, that's their markup. That's their profit on that sale.
It's a pretty nice profit.
Yeah, that's great.
Yeah. So I see $2 amounts. Maybe that can help you remember that you need 2 journal entries for this. But we have $300 of inventory, so I want to get rid of that inventory. I no longer have it.
Do the revenue side first.
The revenue side first?
That's the one I have listed here first.
Okay. Right? So first, on the revenue side, I received $500 in cash, so I'm going to debit cash for $500. And I sold the goods, so I'm going to credit sales revenue for $500.
Nice work.
Whew. There, can I do the inventory side now?
Yeah, no, you can't.
All right. So I was saying the inventory, I don't have it anymore. It's no longer in my store or my warehouse. So I decrease an asset. I'm going to credit inventory for $300. And then I'm going to debit something called cost of goods sold, which is just the kind of like inventory expense. It's basically the accounting way of saying inventory expense.
Exactly. Inventory, we don't have something called inventory expense. It's called cost of goods sold instead. That's an increase to an expense, though. And then let's say they pay off the $300 on account. This is more of a lesson 2 question again.
All right. So the cash is going out. We're decreasing an asset. So we're going to credit cash for $300. And then accounts payable is going to be debited for $300 because we owed the money. That was a liability. And then we paid them back. So we decrease a liability by debiting it. Yeah.
And, just an observation, Ben was talking through that kind of like I would, in that you usually went to the easier side first, right? If cash was involved, it didn't matter whether it was a debit or a credit. You usually just took care of cash. That was the easy way to think of it. And then I like that approach because then you know that the opposite is kind of what you need. If you knew cash was credited, now you know the other side has got to be debited, as an example. Well, if we continue on here, we'll just look at the T accounts. So if I sum up all those journal entries that we just had, and only the income statement ones, so we're not going to be looking at cash, accounts receivable, accounts payable, or inventory, just because we're not focused on the balance sheet right now. But if I look at just the income statement accounts, here they all are. So the service revenues, we sold goods, we performed 3 different types of service revenues. If you went back and look at those journal entries that totaled up to $450, we made that one sale of $500 of goods. We had interest expense, we had income tax expense, we had wages expense, and we had cost of goods sold. Just one point to note on these is that when you do have more than one item in a T account, you sum those up. And in this situation, just everything is on the credit side. If you had items on both the debit and the credit side, you would still, you would kind of sum up each side, but then net them together to figure out one account balance.
And it's more common to have both debits and credits when you're looking at balance sheet
accounts.
Exactly. But it could happen occasionally with income statement accounts too.
Yep, certain returns or something, it could happen. But so prepare the company's income statement using those T accounts. We're going to start with the service revenue of $450, add in the sales revenue of $500, subtract the cost of goods sold of $300, and we have gross margin of $650. We're then going to subtract the $250 of wages expense to get down to operating income of $400, or EBIT. We are then going to subtract interest expense of $100 to get down to income before income taxes of $300. We're going to subtract income tax expense of $90 to get down to net income of $210. And then a question for you, Ben. So if this company had 100 shares outstanding, what would this company's earnings per share be?
I think you kind of gave me the answer, or the way to solve the answer in the question there. Earnings per share. So my earnings is $210. That's net income. And 100 shares are right there. So $210 divided by 100 is $2.10 per share.
You did that math in your head. Very good.
Is this, thank you. Is this a good earnings per share number? Is it bad?
That'll be a focus of lesson 12. But I think the short answer is it's not good nor bad until we can compare it to the company's prior history and to maybe some competitors as well. How much is this company growing its earnings per share versus how is the general economy and its competitors doing?
Absolutely.
Yeah, but it's good that it's positive and not negative. I think that's
I would always take a positive
side.
over a negative.
Totally. Key takeaways from this one as we wrap this one up. We talked about revenues, expenses, and net income. And again, record the revenues when they're earned and record the expenses when they're incurred. Match them to the revenues. When do we record transactions using the journal entries? Well, the revenues are credits and the expenses are debits. And again, cash receipt does not equal revenues, and cash payment does not equal expenses. We follow the accounting rules that we just talked about, and know how to create an income statement as well and go through those various subtotals. That's all I've got. Any final parting comments that you have, Ben?
No, I do love income statements, though.
They're fun. They're fun. Well, we're going to see them back next time for lesson 4, where we get into adjusting entries and pulling it all together.
I'm looking forward to it. Thanks for tuning in, everyone.
See ya.